Hey, Tom's Trading Room. Tom here, and in my next video, we're going to discuss Netflix. I'm not going to spend too much time on the outlook. You can find that anywhere. What I do want to talk about is things you cannot find anywhere, and I'm talking about price and IV charts to get an idea where the fear and greed is prior to earnings. I also want to talk about patterns before and after earnings on both price and volatility. And finally, let's talk about 3 option trading strategies that you can do for around 500 bucks. Okay, so you know that earnings for Netflix are consensus is 161. The whispered number is actually higher, about 168 per share. This kind of information you can find practically anywhere. What I want to show you is the information that you might not find, and I'm actually recording this video a half an hour prior to the market closing and Netflix reporting their earnings. So we are going to look at this a couple different ways. First, the chart. This is a chart of Netflix. As you can see, the first thing I want to point out is that you've got the chart which shows candlesticks. This is the price of Netflix. It's shown to the left. On the right-hand side, I've got a chart of the 7 to 30-day at-the-money implied volatility. Now, if you don't know what that is the pricing into options that option traders are doing. As that number is low, they don't detect a whole lot of range happening in the future. When that number gets high, that's kind of that fear and greed gauge that goes up. And that actually means that they're expecting big moves to happen in the future. The last time earnings came out were back at the end of January. And we saw that fear gauge go up from about, we'd call it right around 28 to 30. Right before the earnings came out, this thing was eclipsing 70. And what that basically means is that the options time premiums of those 7 to 30-day calls and puts were trading at near double the rate that they were just a month prior. Now, as soon as the earnings came out, we saw that drop back down. Because then what was unknown was then known. The stock moved up, then it moved sideways, the volatility kicked down, and of course now we're on to another area. Now the next time the volatility actually moved up was when COVID-19 became a big problem and was making headlines. We saw Netflix go from $380 down to $300. We saw the options implied volatility numbers go from about 40 at the time up to over 110. Well, as Netflix has moved higher, the volatility has dropped down. Traders have gotten calm, but look what's happened in the last week. All right, we've gone from around 370 up to 440 in about 7 trading days. Look what else has gone up. The implied volatility as we get closer and closer to earnings, which are going to be reported in just a few minutes from this video. Notice the volatility is actually higher than it was during the dark days of Netflix surrounding COVID-19. All right, so that's the first thing I want to show you. The next thing I want to show you is we can look at earnings rankers, and we can see that with Netflix, based on its past, all right, past 7 quarters we checked, 5 of those times Netflix beat their earnings. 2 of those quarters, Netflix missed their earnings. Again, this is information based on the past, but here's something I want to show you that you can't just find just anywhere. If I go to an earnings ranker called NFLX, which we have in tomsoptiontools.com, I can run this on Netflix or any other stock, and I can look and see, well, what did the stock do a week prior to earnings over the last 4 quarters? Let's find out. All right, so we found out that it's really a coin flip, that a week prior, it's gone up 5%, down 2%, up 3%, down 5%, down 3%. So over those last 5 earnings checked, it really is a coin flip, what it's done before the earnings report. All right, how about after the earnings report? What did the price do after the earnings report? Let's take a look and see. Again, still down 3%, down 4%, up 8%, down 12%, up 3%, maybe a little bit more tilted to the bearish side because, you know, people were looking at this and no matter what number they were giving, their stock was being sold after earnings. That's something to think about. But the next thing we could do is we could look at things like what was the implied volatility? What were the option traders doing before the last 4 earnings? All right. Were options prices going up? Well, in 4 out of the last 5 quarters, yes, up 48%, up 48%, up 4, up 20, and down 3%, and that was 5 quarters ago. Now, what do option traders typically do with options after the earnings come out? Well, let's look and see. With Netflix, it was a solid last 4 quarters. Options time premium dropped over half, nearly half. So we know the one pattern that exists is you don't want to be holding options through an earnings report, all right? Or at least you don't want to be buying options through an earnings report. But could you sell them through an earnings report? Yes, you could. Let me give you 3 examples right now. Number 1, let's say you are bullish and you want to take a bullish stance that you think that Netflix is going to have double-digit subscription increases and their earnings are going to be above expectations, and you believe the stock is going to be up the same this time tomorrow toward the end of the week. You could look at buying the weekly options where you are selling a put option, all right? You're selling a higher strike put and you're buying a lower strike put. You're going to bring a credit in. And that credit, as of this video, is $545 for a 1 contract spread. Your risk is $455. So what you're doing is you are setting out there a pretty much near 1-to-1 coin flip, risk to reward ratio using options. You can't do that with the stock. If you want to be an investor in a stock, that's one thing. But if you're looking to flip this thing around earnings, it is safer putting together a trade where if you are right, you're going to make a certain amount, all right? Somewhere around just north of $500. And if you are wrong, you're going to lose a certain amount just north of $400. So that's what we call a 1-to, in this case, is actually a 119% reward to 1% cost, right? So a slight edge there for the bullish trader. Now, let's say you're bearish. You don't believe that no matter what kind of revenue and earnings report they're going to come out with, this stock's going down after earnings. Well, you would do the exact opposite. You would look at a spread that involves selling calls, selling the lower strike calls and buying the higher strike calls and taking credit in. And maybe you're taking in $450 and the most that you're going to lose is $550. So nearly a 1-to-1 once again. In this case, it's actually slanted toward the risk instead of the reward. You're going to take in 80% max profit to what you're spending on in terms of max risk. Your spread is going to look like this. If the stock goes down, well, if the stock goes down, your position goes profitable, and you make a certain amount of profit, all right, a fixed amount of profit. But if the stock jumps, you have a fixed amount of risk. But here's the beauty about this trade. Just like the bullish trade, you know what you're risking, and you know what your reward is, and you can do no better or no worse, all right? This is called a bear call spread. Now, finally, what if you're neutral? What if you think it's going to stay in this range? It's going to stay in a certain range over the next few days. Then what you could do is take all the exceptions of the bullish put spread and the bearish call spread, and you can put those together into one trade, and it looks like this. This is what's referred to as an iron condor. All right, we are selling the call spread, all right, a bearish trade. We are also selling the put spread, a bullish trade, and we're putting together to make it look like a 1-to-1. So we're risking, in this case, around just a little bit more than $500, all right? Actually, we're bringing a profit in just a little more than $500. We're risking a little less than $500. This is called a 1-to-1, but it is a neutral trade as long as Netflix is somewhere between, in this case, I'm going to give you the break-evens on this trade, between $394.70 and $485.30. If it's in between these numbers, all right, by Friday's expiration, we break even on the trade. In fact, if you want to see a maximum profit, as long as we are between $400 on the downside and $480 on the upside, then we make a maximum profit on that trade because everything expires and you get to keep the credit. So the thing is, one of these 3 trades, possibly 2, are going to be right. Now, when are we going to find that out? Well, we're going to find that out by the end of the week.
Okay, so now we know that it is hard to predict price through an earnings report. All right, it's much easier to predict volatility through an earnings report, and we can trade options and put the volatility on our side. All right, if you like this video, hit that like button below, and if you want to see more of these, hit subscribe, hit that notification bell if you want these on a timely basis. This is Tom Gentile. Until our next video, I hope your trading goes well. We'll see you then.